Welcome to you all. Today's subject is succession, sale, or scale. What's next for your business? My name is Kerri Sinclair. I am the editorial board chair of Automated Buildings, but probably more importantly for this panel, my background is I co-founded and sold my startup to Microsoft in 2007. I've been a senior executive in two companies that were private that we then listed. Investor exiting my investments both through IPO and trade sales. And I'm currently in the succession planning of Automated Buildings from my dad and mom, who started it more than 25 years ago. So, it might sound like I can talk a little bit about the subject, but I clearly have much more and interesting people beside me. So what I'm going to do is have them each introduce themselves and a little bit about how they fit into this subject and why you might be interested in their thoughts, and then we will start. So, go ahead.
Good afternoon, everybody. My name is Phil Wojcik. I work for Warren Equity Partners. I'm the private equity. I'm the PE guy in this afternoon's panel. Warren is a specialist private equity firm. We work exclusively with companies that perform what we consider to be essential, non-deferrable services. There's 4,500 private equity firms, at least in the US, so we'll talk more about the differences in those as we go through. My background, I spent a fair amount of time in Fortune 500 with Honeywell and PPG. I then moved into a family-owned company that was going through the acquisition from private equity. And after that, we added 10 other founder-led businesses to that group. From there, I moved into working full-time with Warren Equity, the private equity firm, and what I spend most of my time doing is working with companies in the commercial and industrial facility space, working on how to scale and grow them in a private equity world.
Great. Scott?
Scott? I'm Scott Cochrane, Cochrane Supply. Cochrane Supply is a almost 60-year-old company. My father started it in 1967. I took it over almost 30 years ago, and I won't say I was groomed for it, but I did have the ability to spend a lot of time with my dad and the people who started the company. And Cochrane Supply has grown up quite a bit, and we're looking at our future, and we're kind of looking at it as something where we plan to keep it a family company for the foreseeable future. So it's a little bit of we're in a different situation than maybe some of the others. So that's kind of our story.
Right. Thanks, Brian.
Yeah, Brian Turner with OTI. It's similar to Scott. I got my start at Controlco and ended up running, that was being run by my dad. Scott and I came into this business at the same time. Are you sure it's really been 30 years?
We graduated high school at the same time.
Long damn time. And we caused a lot of problem for our fathers at the early meetings, so we had a lot of fun. But more recently, we have acquired businesses, we have sold businesses, we have taken investment from PE firms and gone out for second round and gone through the woes of success and failure and all of those things. And now we are a master system integrator, and the companies that were invested in was a software company that we had built and now has been sold off. And so our investors are still with us, but I think if our investors were in this room, they would acknowledge that a master system integrator in a services business is not that wasn't the thesis of their investment. And so it's really interesting as we kind of go through this process with a board full of investors that invested in software and now are actually on the board of a services business, and they're learning and still a very good board, very helpful as much as they can be. But it's just been a very interesting transition. And there's lots of things that now I know, I wish I'd have known 7-8 years ago about what to do to plan for any kind of investment or acquisition if you're on the sell side. So that's really where I'm going to be coming from on this panel.
Great. And last but not least, Josh.
Thanks. I'm Josh Redding from Sunbelt Controls. My perspective is a little different. I'm a contractor, so those of you contractors in the room, I'm one of you. But My company was acquired by Sunbelt Controls back in 2010, and since then I've became their president and have been scaling and driving that business to 4x what it was since I've been there. Through that have been some acquisitions, some good ones, bad ones, a little bit all the above, but we do things a little bit different, more from a contractor's perspective than maybe you're going to hear from the rest of them with PEs and others. We go at it a little differently, but we'll get into that a little more. But I've been in the HVAC industry for longer than these guys. So apparently I'm older. I don't know, 30-something years. But yeah, I've been doing controls pretty much my whole life. So I happen to grow up right when pneumatics was going away and nobody wanted to touch the computer. So that's where I came in.
Great. Well, I'm a bit of a data geek. So, I guess what I wanted to frame this with is there's currently roughly 114,000 HVAC contracting businesses in the U.S., and most of those are family-owned. There's been 149 transactions in 2025, and that was up almost 13% between the year before. So, maybe we'll start with a question to the audience. Who here has had someone ring them cold call and say, are you interested in selling your business? Put your hand up. Yeah. So this is why we have this session, is to use the experience of all these people here to say, what do you do? And, how do you make these decisions? I typically, just so you understand my understanding is where the industry is here, is residential HVAC contractors have been the focus. They're moving into commercial. So you may have had other people doing it, and we have all the experts here to tell you why that this is happening. But I wanted to start with the sale, because I think one thing that you don't understand as a family-owned business, and we can have people here who can talk about it, is in your local market, you know who your competitors are, and they may be other family-owned businesses. And if you don't sell, and they do, you have a new competitor. You have a competitor that has changed from the competitor that you've had for the last 20 years. So you're going to have to start thinking about your scale and succession plans now with new competitors and new markets. So we might start with you, Phil. Why are you ringing everyone?
So we think of, in a lot of private equity firms the same way, these are really exciting spaces to be in, right? So go back to, how Warren Equity thinks about this. We like spaces that are fragmented. We like spaces where they perform essential services that can't be deferred, right? When your HVAC breaks, it has to be fixed. You don't wait on that, you don't defer that. We like things that we see a good tailwind of growth in the market. So it's a really attractive space in there. We also believe it's one that can grow very nicely through scale. So we see this as an attractive space. It's fragmented. It lends itself very well to building some size, building some scale, and growing. And as much as I would like to say we're completely unique, private equity is a little bit of a copycat industry. So lots of people go round and round and round looking for opportunities in the space.
Right. Just again, I did a bit of data. 39 of the 77 transactions that were done in the first half of 2025 were done by PE in the space. So Josh, you might have done some of the other ones. So maybe get a counterpoint here about what you're looking for and how you're thinking about it from your perspective.
Yeah, so from a contractor's perspective, we kind of do it a little different. Ideally, we want it to be in a geographic that is conducive to maybe our other ones, adjacent to where we might have other support or other people. But being a contractor is really about our culture and our people. And so what we really try to find in somebody that we're acquiring or would like to acquire is that they have similar culture and similar atmosphere, because for us, it's all more about the people than it is consolidating and trying to do something different. We do, similar to the PE example, is, when we do acquire somebody, we do have a greater support for them in different locations, so they can definitely call on others and kind of act differently than they would have if they were a family business originally. But for us, it's a little more about the culture and is it the right fit, and are the people going to fit into how we work and how we operate. Obviously, the way we acquire is a little bit different too. I'm sure we'll get into some of the detail, but we look at EBITDA at the bottom line, and we take history of your EBITDA over 3 years in the past, sometimes 5 years, depending on how old you are as a company, and then we do the same in the future, meaning your future projections and what you believe is in your forelog, and then we kind of bundle all of that with the people approach from a contractor side. So it's a little bit different, but seems to work when you get the right people. It definitely doesn't work when you get the wrong ones. So you got to watch out and make sure that you do diligence through the whole process to make sure that they have the same aspirations you do to come together. So.
And Scott, you've mentioned that you've been doing a little bit of it on your own as well. I mean, how do you differ or, I guess, agree with either of the other panelists on this?
Well, same with Josh. I mean, if you're ever thinking about doing an acquisition, EBITDA, earnings before interest and taxes, that's the magic number. And typically you want to use a multiple of that. So you take a 3-year average and then you take a multiple of that. So like, say the company earns $1 million a year as a 3-year average. A distribution company gets about a 3 to 4 to 5 multiple. So, that $1 million times 3, 4, 5, that's what we establish as the value of the entity, just to give you a reference. If anybody's never done that before, it's a very basic math, right? Isn't that kind of how it works? I mean, no, I'm kidding. I'm sure he does a much more elaborate thing. But anyways, that's the basis of it. We are expanding our markets and we're moving into new markets. And we've been friends with a lot of distributors for a lot of years, and some of them are looking to exit the industry. And frankly, our acquisitions have come to us. They've asked us to come in and take over their business, primarily because they want to make sure that their customers get serviced properly in the future. And the owners of those businesses worked really hard, and their reputations are really important to them. And they wanted to make sure they leave their markets in good hands. And we were fortunate to be picked by a couple of them. So we don't chase acquisitions. We're more looking to help our friends where it makes sense and continue to expand geographically where it's open. So.
Brian, anything? I know your experience on this is slightly different. I mean, I think the challenge is that it sounds all good, but the reality is you start to do this dance, let's call it, there's some missteps.
Well, yeah, I mean, if we're talking about when we were acquiring companies, the challenges we had when we were trying to expand into a new geography is you do try to make sure the people and the culture matches what you're doing. And then you'll look at things like EBITDA. And a lot of times the people looking to sell to you, especially if they're coming to you, it's because they have been unsuccessful at finding a partner that will buy at their desired amount.
Yeah.
Right. And so
I didn't get by good companies.
A lot of them are struggling. You know this. A lot of them haven't figured out a succession plan. They don't really have another way out. And so there's a little bit of desperation, which is one of the things that when I'm talking about what you need to do on the sell side is definitely don't have any desperation in your voice. And so when you acquire those companies, sometimes the owner wants to get out. And sometimes the other management will get out with it. And so you end up with maybe some great employees left, maybe all of the knowledge just left the room. And so you have to be very cautious when you're acquiring and make sure that you're asking all the right questions. And if you are just acquiring, because what we did was just acquire for territory, we weren't all that concerned about who left, because we knew that we were bringing people into that region. And so it wasn't that big a deal. But again, people who buy for lots of different reasons. And it, that's a big thing to understand, especially if you're the one selling, is to understand what their why is. When you understand what their why is, there'll be a lot more success.
Yeah, just jump in.
I think what Brian says makes a lot of sense, and I don't think it's dramatically different whether you're selling to private equity or whether you're selling to an industry player. the thing that I tell people is, alignment is important, and alignment has 3 dimensions. You want to be aligned on the value of your company. Nobody misses that one because that tends to consume all the discussion. You want to be aligned on the strategy to grow the company after you're acquired, because whether you're an industry player or private equity, people have very different ways to grow the business. Super important to be aligned on that. You want to be aligned on how your new partner is going to manage the company. It's similar to what Josh said on culture. If it's private equity, some are very hands-off, some are very hands-on. It's very important to be aligned on those 3 dimensions. And if I could make one broad sweeping statement on all acquisitions, when those 3 things are aligned, they tend to work out well. When those 3 things aren't aligned, it sucks. It's bad for the acquirer, it's bad for the company that's sold, it's bad for the employees. So if, whether you're thinking about partnering with an industry player or private equity, if I would try to sear one thing into your brain, be aligned on value, aligned on growth strategy, aligned on how you're going to manage and work with each other.
And I think from my experience, people don't think enough about partnering ahead. There's always someone upstream from you or someone in another geography who you might admire, and maybe you meet at an event like this. You can start partnering as part of scaling your business, before you actually sell it. And once you realize the culture fits good and you've got some alignment, then you can start talking about a possible transaction in 2 to 3 years' time. These decisions are not, at the fundamentals that I'm hoping that these people are sharing with you is it's fundamentally a good business and it is worth investing in. So now we can go a little bit more broadly into kind of so that's kind of the sales side of it. Now, scale and succession, because we will come back because some of these transactions end up kind of ending up on the same thing. And anyone open now and just talk on top of each other? We'll get a bit more dynamic going here. Thinking about that concept. It sounds like that's an option. Scott, you're saying that you don't approach anyone; they already come to you, and they want something that you have already to some extent. How does that work? Like, if someone came to you and said, "Look, we're not ready to sell now, but we want to start working with you in this region," is that something that you do day to day, and you think about how that grows your business?
Right. It's part of a succession plan for the individuals because a lot of people don't have family or people inside the company that want to take on that responsibility. I find, for me, a lot of the people I talk to, that's the bigger problem. It's not like they don't have family or good people in their company. They don't have people within that want to take the responsibility, raise their hand and say, hey, I'll do it, right? So that's usually the reason why. And when they realize that and they decide that they want to, like I said, like the people I worked with, they made a systemic decision that they were going to take care of their customers who took care of them. And so then they started really looking for a buyer that made sense for their customers. And that's how it kind of came to be. But
yeah, to the point of partnering, what we've done in multiple occasions is invested in somebody. So maybe we get 25% share, maybe we get 40% share. We sit on their board. We partner with them in, different geographics and different areas. But generally, we go in like a silent partner almost, really, to make sure that we align with everything you're hearing today. So we want to make sure we align with their culture and our culture and how they do business, and do our core values line up with their core values? And so we have some avenues where we've done that, and most of them have been successful, more than the ones that we do acquisitions that we just come in and do an EBITDA multiplier. If you guys haven't figured it out, the distributor gets a little less, the contractor gets a little bit more, and PEs pay the most.
software companies get a lot more.
Yes.
Yeah.
And software companies get all the gold. But the partnering piece is a big piece, and it's a great way to make that alignment as you go. So it's been successful for us.
All right, so I want to flip this to the seller side because that's I think honestly why I'm up here. So on the sell side, you really want to take advantage of all those calls you're getting. All of those calls you're getting, do you want to sell? You don't have to say yes, but you can have the conversation, and I encourage you to have it. When we were looking at getting an investment, not selling, but getting investment into our business, I spoke with 30 or 40 investment firms. I spoke with 10 to 12 bankers who were looking to bring us to the table, to their people they were talking to. And I was just learning, because alignment is so important. And I feel like I did a good job there, because the investors that are on our board still do a great job. We still have really good conversations. Even the tough ones are respectful and good. And I learn from those every single time, and they learn from me. And it's been a good partnership there, but it's only because of the investment in time that I did well before I ever took any funding. The second thing is understanding what you are getting funding for. I certainly knew I wasn't ready to exit, but I knew my dad was. So I knew that I wanted to take a little bit of risk with what was the next chapter in our company. And so I didn't want my dad to experience that risk, right? So I helped him get out. His money is now safe and with him, and now I've put my portion of the company now at risk, and now I have a PE partner to actually go and build that together. The third thing, and this is something I didn't do well then, doing much better now, as we prepare for what's coming next, 3 years, 5 years, 6 months, who knows when the next transaction will happen for us, but it's really around what my chairman of the board calls a sparkle test. Because there's one thing to be a rough cut diamond and think you're worth $40 million. It's another thing to be very, very shiny and sparkly. All your stuff's in order. When the PE firm comes in to look to invest in you, and you have everything ready and everything is clean, everything looks good, you understand what they want, and you're giving it to them before they even ask, you're gonna get a higher multiple, guaranteed. You're gonna create a whole lot of demand, because a lot of those firms are gonna want to talk to you. And you're just gonna have more success overall. So it's investing in that time. And the thing that the chairman of our board really, really made clear is that the sparkle test, this process that we've gone through, it's not just something you do to sell. It's actually really good business fundamentals of keeping these records always at hand. And that's something that, as a small family-owned business, that's not how we were thinking. That type of thing of being sparkly to somebody else wasn't really a part of our ideas. But if you're thinking about, in 5 years, I think we're gonna have to do something, whether it's transition to an employee, a family member, or we're gonna have some investment from a PE, or we're gonna sell to a contractor. Being very sparkly and shiny to demonstrate the value that you have, and it's not just rough cut and, hey, we're really valuable, and if you just shine us up here and here and here, we're really shiny. They're gonna charge you for everything they have to do to shine you up. And that's something that you guys, if you're interested in getting acquired, getting investment, regardless, you want to drive the highest multiple you can. And so that means making yourself look really, really attractive.
Well, and I think the other thing I used this example when we were met before is one of the transactions I did, we had 77 interested buyers. We got down to 7 non-binding indicative offers, which is a term that's used in the industry. We ended up with 3 binding offers. It was 14 months. And in the interim, our business stopped performing the way we said it was, because we were so busy doing the transaction and answering all the questions that we ended up destroying a lot of value on the transaction. We ended up selling at 100% share sale, which is something that's, again, strategics versus financial buyers, so it'll be different transactions. But the hardest thing is that you then have to still be running the business and hitting the numbers that you actually said you were going to hit as part of the initial conversations. And so there is a trick. It's not just like, over one hand you're over here, and in the other hand you're talking to 35 PE firms and owners, right? Like, you are really going to have to make sure your business is in order so that you can have it running, so that you can go have the conversations. And so if you can't say that you can do that now, you're not ready for the transaction. You're not ready to even have the conversations. You can start taking the calls. We've gotten calls at automated buildings, people wanting to buy it, obviously having no idea what it is. But the point is that, if you can't have those conversations and know the business is running along and growing on the numbers that you've got, you're not going to get the valuation. And there are people, and I'm not saying anyone on this panel, who will actually purposely delay you to wait for next quarter's numbers to then have a valuation conversation with you to cut a couple of $1 million off that price they want to pay because it suits them. Their incentives is not to get the money to you quickly. Their incentives is to get the money to you later so that you actually have been able to prove that the business is quality. So it does sparkle. It hasn't just been sparkled for the sale.
So I'll give a view from inside the private equity world, right? So not different than what Scott and others have said. We are out looking for companies. We want well-performing companies. We want companies that have a vision to grow their business together with us. And we form an idea and we form a valuation based on how that business is performing. And what I say to anybody who gets into anywhere into a deal process with us is, whatever you do, make sure you run your business first, run the deal second. Because we formed our views on growth and value based on the numbers you gave us. And, if those numbers deteriorate, the business is worth less. And we are super upfront about that because I do not want to go make money off you because we agreed to this. Now, you stumbled. Now let me pay you less. That is a horrible way to start a partnership. So if you do get down that path, and I don't think it's very different whether it's private equity or somebody else, they are forming a value of your business based on a level of performance. Manage the business first, manage the deal second. We can close later with good numbers. Closing sooner with bad numbers, horrible way to start a partnership. Avoid that at all cost.
Yeah, and just know, getting the sparkle isn't always like this tedious task and take you years. Like, if you just think about it, when I sold my company, it was mine, family owned, whatever you want to call it. But in doing it, it's really separating those things that we do as owners that are kind of the gray line areas, right? Is that condo really part of the company, or is it just in Vail, Colorado because you like to ski, right? So if you just think about those things, whether they're personal vehicles, whether they're, just all the things you want to write off as an owner, which is a great thing to do. But a lot of those, you got to kind of departmentalize them and, make the shiny objects shine, which is your work, right? It's your people, it's your work, it's your revenue, it's your backlog, and then just know those things could still be in your books, but just be aware where they're at, what they are. And so whether it's private equity, whether it's, somebody like ourselves who come in to acquire, we're going to ask you those questions. Like, do you actually own that car in the company, or does your wife drive the Mercedes? Because we don't have very many Mercedes with a truck with a ladder on them. So those are all just little things you can be doing to prepare yourself. And it is succession, like Scott said, is a lot of what we do is succession, which is, people want to get out. It's like Brian's dad was ready to be done and Brian wasn't. That's like perfect candidates for us, right? Somebody to lead the business, but the owner wants to get out, whether that's, right away or down the road. It's the people for us. So if somebody wants to be done in 10 years, it's great. We still need somebody to run the company, right? So, but the point is just to get the sparkle. You don't have to go through an elaborate, measure to get there. As much as you can hire consultants and you can hire people that can help you all do this. Again, just costs more money, right? But if you just think about those things that people are evaluating you on, EBITDA, your, backlog, your revenues, like those are things to make shine, and just, take out some of the gray. Don't take it out, still write it off, but eventually they're going to go too much gray. Like, that's not us, right?
So I'm going to open up to questions because I know there's probably a lot of people in the audience. I'm just going to make sure I've addressed the scale. So any of you answer this question from your perspective, but I've got a great business. It's growing. I'm really happy. I'm 35, 40. I know what I'm doing, ready to go to the next level. How do I think about acquisition and or growing through I guess effectively what it is organic growth is when you can grow yourself just with your own people and your own strategy, and an inorganic growth is where you actually, tend to acquire something that is a bolt-on, as they call them, to make it bigger and faster. What any advice do you guys, because some of you have that experience about thinking about, okay, actually that's great. Maybe I want to sell in 10 years' time or 20 years' time, but how do I think strategically, and what are the things that I do to think about the value of those decisions that I'm making to make sure that I am getting that scale and value?
I think the biggest thing is to be honest with yourselves and be honest with whoever you're talking to on the investment side, whether it's a private firm or a PE firm. You do not have to put verbose, unrealistic BS in your projections. You can be certainly optimistic, but in a lot of cases, you've never scaled more than 50%. That was when you're really small, but if you're of any size, you've never really grown year over year across a 3 or 4 year process more than 15 to 20% probably. And so if you start showing projections, well, hey, if you give me $10 million, I'm gonna grow 400% over the next 3 years. And I'm gonna drive my evaluation way up. And what's gonna happen is you're gonna end up with that really negative outcome after 2 years when you're not anywhere near those projections and you're starting your offers getting written down and written down and written down, you're not happy. So it's good to be optimistic because you're taking in fresh capital, you're taking in a fresh partner, you're taking in something that should really allow your business opportunity to scale. So be really solid in your fundamentals, be really solid in your vision, why you think adding this money is going to do it, what actions you're going to take, and how you're going to actually hit those. And then have strategies and plans for how you're going to pivot when it's not working like you thought it was going to. Because almost always, we're not very good at crystal ball effect. Like something's going to be there. It'll be an opportunity. If you're ready for it, you can pivot and take it. But you have to be realistic about those things. And if you are, you'll hit those numbers. Because I've seen lots of people hit the numbers when they've taken investment, when they've done earnouts with Josh's company. It does succeed. It's not doom and gloom. I know we've said some of it like, oh, if you're not ready, it could be. It can be. But there's also a really good upside. If you're just honest with yourself and optimistic but not ridiculous, you can hit those numbers and you can have really, really good success.
Someone said to me once, it's like a bathroom renovation. It takes twice as long and costs twice as much as you expect. So, factor that into whatever you're planning in regards to that.
I mean, the quick thing I would say, in my mind, sale and scale are two sides of the same coin, right? I mean, I think of this as business owners, you're trying to figure out how to grow and develop your business. Do it on your own is viable. Do it with industry partners can be viable. Do it with private equity can be viable. I think it's all about thinking through how you want to grow your business. I would say, if you put a dimension of speed in there, organic and acquisitive is a good way to go. There's a give and a get to that. Good news is it's fast and you can go quickly. Bad news is it may not be a natural act and it's hard to do. So you can do it too fast and you can stumble. But again, from the private equity standpoint, we think about this as everything we do is buy and build. It has to be organic growth and it has to be augmented, not replaced, but augmented with acquisitive growth.
All right, now someone was very quick when I said I was going to open for questions. So Scott's going to run the mic down to you. We've got quite a lot of people in the room, so if we can wait to take questions when everyone can hear the question.
Thank you very much. Great panel. Josh, you were talking about the importance of financial organization, and I was wondering if you recommend to the business owners in the room a financial audit, a financial review, or if they don't have those things, maybe a sell-side quality of earnings.
Yeah, a financial audit's always a good thing to do, meaning it's probably the least expensive out of the options that you would have. It's good to just check your own books, right? Like sometimes you think it's clean, but third-party eyes on them give you a whole different perspective. I think calling in consultants and doing some of those things. I've had plenty of people do both. It's some people want the insurance from a consultant saying, here's what you should do, right? Because it's, it's your livelihood. It's something you built, something you value. And it's hard to want to, go, is this really the right number? To Brian's point, you think you're worth 40 million and we think you're worth, 5. So the challenge is, how do you get, realistic? I mean, Brian made a good point of being realistic with yourselves of what do you want out of the company, right? And depending on what you want is going to depend on how deep you need to go accounting wise, in my opinion. Anyways.
Any other questions? There's one over. There's one. Maybe take this one here, and then you can go. We'll take this. Sorry, just can you wait till you get the mic, please? And then we'll go over to you when she gets some time to get over there. Sorry.
Hi, Erica Stock here with Harris Company. We're a strategic acquirer, and I just wanted to add on to what you had asked, that it is really important for the companies that we purchase. We want you to talk to consultants. We want you to feel safe and comfortable and confident, because in 3 years, we want it to be the best decision you ever made to sell to us. So the one downside I do see is when people go to consultants in a space that they don't actually know. So I had a really great deal going, and this gentleman went to an accountant who was a CPA, that's all he ever did, and he was told his company is worth 50x. And I'm like, it's not. Can you please go talk to a valuation or somebody in M&A who does this? Like, we want you to do that. And unfortunately, he didn't, and he's still on the market, X amount of time later. But just make sure you're going to the right people to value your business. That's it.
Yeah, it's a good point. Is Scott talked a little bit about it from distribution. I was kidding, but not kidding, is we look at EBITDA. We all do, right? It's your earnings. And so we do an average over that. So to Brian's point, if you come up with unrealistic numbers, it doesn't pencil out, right? And then some people, particularly, we have some growth areas in the U.S., if you're in the state of Texas, you're probably growing 2x right now. And people are like, hey, I'm going to wait and grow 2x because I'm going to be worth more. Sure, you are. But to Brian's point, even over that 3-year average, even if you did, twice as much as you did last year, your average puts you back to where it is because there's some reason that happened, right? Either a population moved in, a bunch of schools happened, data centers came, some big job you got, some hospital that's, 20 million, and you think it's going to change your evaluation. It doesn't. And so it's a good point to those.
Just another add-on to what you had to say, and everybody, sorry, it's kind of loud. I'm a volleyball coach, so I was really loud. One of the things you said about making sure everybody's clear about what's on their books, and it's not like you're putting out there, oh my gosh, I spent $250,000 on some car, the condo and stuff. Don't be scared of sharing that information, because your EBITDA is going to go up, and that means you get paid more. So please make sure you know what those expenses are that are associated with the business. It's not to out yourself or anything. It's actually better for you to do. So, sorry.
That's all right. Thanks. We had a question over here.
Hey, everybody. I'm Chris Renock. I work at Carter Morrison Goodrich. We're actually investment bankers for family companies and work with HVAC. So appreciate your time. Appreciate the panel has been great. Particularly Brian hearing from the sell side perspective. The question is kind of high level, but from your perspective, we probably have some manufacturers, distributors, service contractors in the room. Where are you seeing the biggest opportunities, and what are you looking at, both from that end market perspective as well as called from a size perspective? What gets you excited in terms of revenue, in terms of EBITDA, the metric you've been talking about? Like, what checks the box for you?
Is that for me?
Yeah, anyone?
He said mine. I think it's for everybody. Yeah. So, we have changed a lot in our businesses. And I had 3 different businesses over the last 30 years. So the one I'm excited right now, we're very much a MSI, Master Systems Integrator. We install controls. We provide professional services, analytics, a lot of technology-based services to end users, as well as service contractors who maybe don't want to have that stuff insourced. And so I see that ability to provide services to service providers for the facilities is just huge, because the ability to scale people in 1,000 service contractors is much more difficult than the ability for me to provide that service to 1,000 contractors. And I think there's a huge opportunity, and it's pretty exciting when we look at the transition of retiring individuals coming. The boomers are definitely getting close. If they haven't already retired within the next 5 to 7 years, we won't see very many of them in our buildings anymore. There's a huge amount of knowledge base that's transitioning out. In those buildings, there's a lot of investment that still needs to be done. And I'm not talking about the Class A+ buildings who have invested millions of dollars to make their buildings really smart. There's a whole building class out there that hasn't invested very much over the last 30 years. And as they're aging, people are retiring, they're also having to put new technology, bring their buildings up to snuff. And you've got a whole new generation of workers that's expecting that, honestly. They're not expecting to come to work without that level of technology that they've been using since they were 3, right? And so it's pretty exciting right now to see what's going on in digital transformation, and for all of us to be able to be part of it. And I'm sure that's why the investment community is highly involved and interested in it. So it's hugely exciting. I just want one more point on this Sparkle test, something that I think all of us small businesses don't put much value on, but will have a huge impact on driving higher predictable growth when you're doing acquisition, is actually having really good understanding and knowing where all your contracts are and what your contracted and liability is and how long those are and how repeatable they are. And the other one is having a really strong pipeline. You want to actually prove that you're going to hit those 3-year numbers, then show that you've had a pipeline and that you run your business with a sophisticated sales model. And if you don't, that's just going to be questions you're answering. To Kerri's point earlier, you take a 9-month process and turn it into 30 months because you're sitting here going, I don't know why they want this. We've never had to have a sales pipeline before. We just get business. Like, that's a good way to actually devalue what you really want. So that's another piece of that Sparkle test.
Just to pile on to Brian's comment about the Sparkle test, and again, whether you do it private equity or whether you do it privately, the process to find the deal and close the deal, think of that as 6 months. The process after the deal is multi-years, right? So 90% of the time you're going to spend is after the deal. Think about that a lot. And to the Sparkle test comment, anybody who's thinking about acquiring you should be having that conversation about where do we want to be in 5 years before you close the deal. So, before that deal closes, you should be thinking and talking about where do we want to get this thing in the next 3 years and the next 5 years. You should have open conversations. It's another dimension of alignment that I mentioned. Anybody worth their salt, private or private equity based, should be having that conversation with you. It's not a state secret.
Josh? Sorry. That's all right. Josh was.
I just want to add on to your question. Like Brian, I think it's exciting. The technology and what's available to us today is a lot different than it was. And so, we talked about succession and scaling. And so all of you mechanical contractors are in the room who don't want to have this technology maybe in-house, and that's not your expertise. That's your opportunity to go partner, whether that's with investment bankers, whether that's with somebody like Brian and his company, or somebody like us who's just, really controls centric contractor, right? So partnering and doing that is all exciting stuff with the technology. I think there's a lot of areas you could gain just from going out and partnering. We have at least a dozen mechanical contractors that use us like we work for them. So when a service call comes in and you're Brian's Mechanical, we answer the phone. Brian's Mechanical, how can we help you? And we get online and check out your facility. And then when there's a problem, we call Brian's Mechanical and we go, hey, the economizer's stuck. Go out there and you have a service call to go do it. We've already checked it out. Here's the air handler. Here's the information that you need, blah, 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 right? And so there's a lot of opportunity to partner to help scale and grow your business that way too. So just on your question.
On the scaling, just a quick question for the audience. How many of you are in the BAS industry or having a hard time finding work right now? Yeah, no one. No one. And the business is changing more rapidly than ever with the new technology coming in, AI, the cloud. So if you think about it from a business opportunity, and if you've been in the industry for a while, in my opinion, we've never been at a better opportunity to scale as an industry. Whether you're a contractor, distributor, engineer, you are in demand. And if you choose to answer that demand, you can scale your business up. Now, Cochrane Supply, we open new branches and markets all the time. We know how much it costs to open a branch in a market, like hire somebody, put the inventory in, all that good stuff. And when we look at an acquisition, we look at it directly against the cost of organically doing it ourselves. And we make a direct decision whether we're going to continue to talk to that entity or not, just based on that. Because if I can go into a market at a certain cost, why would I spend 10x that or 5x that just to pick up a couple of people that want to retire that happen to be in that market? So, and again, scaling up right now to me is not an option. I think my dad taught me, if you're not growing your business, you're losing. And I've just kind of lived that way. And I've never seen it as opportunistic in my 30 years of running a company as it is right now. So.
Great. There was actually a few questions. I don't know. Oh, sorry, the mic's down back here. Sorry, there's a question in the back.
How you guys doing? I have a quick question for you. EBITDA is kind of the gold standard. Our company analyzes basically everything that's coming into the business from the click all the way to the revenue. The thing that we see and when we talk to clients is that they have this bucket of estimated lost revenue, where there's proof of, because of overcapacity or they have a good name, they essentially, because they think in terms of cancellations or estimates and stuff like that, and our software basically will estimate that lost underlying revenue. So, for example, a company for the last 3 months that we just looked at, they had revenue of $1.15, but their overall revenue could have been 4.5 if they were efficient when they had everything. And that estimated lost revenue, that metric that we take a look at, if a company came to you guys and showed you that, like, hey, we need to be, if we were more efficient, would you guys consider that as far as evaluation for companies, or you guys would just say, hey, because you got 1.5 or whatever the EBITDA is that, would you guys consider that part that basically it's called leakage, that we call it?
Yeah, we're contractors, at least I am, so we have a lot of leakage because some days are good and some days are not so good. But when we evaluate companies, we, to Brian's point, hopefully they have a funnel and they show us where they're getting business, who their customers are, where their markets are. And typically in our business anyways, in controls and in contracting, the revenue losses are definitely there, but it's really about, how they handle them and how bad they are, which at the end of the day just affects the EBITDA. So my point being is they had $1 million contract and things went south early and they lost that $1 million contract, we wouldn't even see it in the EBITDA, right? So when we evaluate them, it's really about their gross profit and, what do they do? How much overhead do they have? And the revenue obviously is the driver of all of those things, but the result is basically your bottom line, which is the EBITDA mark, right? So at least for us, we don't really evaluate the lost revenues. We always know of some. And to Brian's point, if you have your jobs in line, where they're at, work in progress, where they're at from a completion standpoint, and that's true, meaning you're not making things up and you think you're farther along than you are, and all those things get flushed out in your EBITDA because we evaluate all that work in progress as part of it too. So,
I'll give you the private equity. I'll give you the private equity view from trying to sell businesses with specific dynamics. What I believe we can get some credit for If you are doing a ton of organic branch openings and it takes a while for those branches to scale, you'll get some credit for future growth of that. If you have a job that went sideways from something like, and a meteorite hit the earth, it would never recover, it was never my fault, maybe you'll get credit for that. Lost revenue, and it's not what you're gonna wanna hear. Very difficult, so just to put it in, be binary terms, very hard to get credit for, no in my book.
But just know to Brian's point about getting your contract straight, we've had a lot of contractors go, yeah, we got this job. And it's like, do you have a contract? No, we have an email and we think we're going to get a contract. And so we evaluate those things differently based on how you get them, right?
Yeah. So there's a new question here.
I'm a contractor and recently had on my mind growth through acquisition. And ironically, a couple of weeks later, I was approached by someone who wanted me to consider was I open to the idea of acquiring their business. And I was kind of excited at first, and then I thought, he's in the dryer vent business, and I'm thinking, sounded great, on paper, initial look, it sounds great, but we're moving towards technology that doesn't require venting in appliances very often anymore. And I'm thinking that's a dead end. And maybe I could pick up those customers for other things, so maybe I should look at it that way. But I guess I just wanted more of a comment from the panel.
I mean, from what you just described, it does not sound like the right fit for you. And the synergy between your business and the business you acquire the integration is so hard. Just to get them to kind of like follow your culture and stuff, that alone, to think about doing that in a whole different way, like in a different part of the business, I think it makes it really challenging. That's my opinion.
I mean, the thing that you said that resonated with me, it's in a space where technology is limiting the use of it. If I were, a wealthy billionaire investor, one of the first things I'd want to know is, am I investing in a business that has really good growth prospects? Is it going to grow in good times and bad? And if I had that, then I'd go through all the questions of good fit, can I integrate it? If I were worried about the future growth prospects of that, me personally, not my cup of tea.
Sorry, I think we've got a question here, and then we can go.
I want to add one quick thing to that. So, like Scott said, evaluate your cost to go get those customers on your own versus acquiring this company. And you'll probably find that the effort to go get those customers from a company who's kind of being driven out of business by technology and innovation is probably less expensive.
Yeah, I'm a contractor as well. I guess my question is that what is the real benefit if a company's doing really well and growing on its own to trying to bring in investors? I mean, and I guess a follow-up question or kind of part of that too is when you guys invest into a company, is it you're taking 100% ownership of that and the contractors then walking away, or there's a percentage? I know you mentioned, Josh, about being on their board as more of a silent partnership, or is there just a spectrum of those?
Yeah, I think we'd probably all answer this, but I think it all depends on your company, right? And what your goals and what you're trying to achieve as a company. If you're doing great on your own and you're having the growth you want, and you're not trying to retire in the next 5-10 years, there's not a whole lot of reason to sell. Like, keep doing your thing, keep being successful. And if you have aspirations to do more, like when I sold my company, I was a smaller company, and part of my sell of my company was so I could be in 5 different states tomorrow and have 400 employees behind me instead of the 25 I had or whatever. So it's about what you want as your company and how you want to drive it. Because, realistically, at the end of the day, we're talking about EBITDA multipliers. Even when I sold my company, what I got was, I'm going to guarantee you the money you make for the next 5 years, you don't have to worry about it. because I got a 5x multiplier, right? The good part is, to Brian's point, I had an earnout, so my 5x turned into 12x, right? But it's because I grew it, right? Because I was trying to go be bigger than I was. So I think it's all, you got to answer your own questions of what's your aspiration and your goals for your company, and do you want to expand? Do you want to contract? Do you want to get your dad out of the business? Whatever it might be, right? So it's kind of different for everyone.
So kind of the checklist I'd run down, right? What is it outside investors can bring, right? They can bring capital to invest in. They can bring talent if the founder wants to step away from the business. Doesn't sound like 1 and 2 are an issue for you. What they can also bring is experience in scale and acquisitions, right? So one of the things that I talk about with a lot of companies is, I may not be the expert in your industry. I am working with 8 companies who are trying to scale and grow in similar spaces. I work with a team of people that have done hundreds of acquisitions. So when it gets into those things that there may not be familiarity with scaling at that pace with acquisitions, those are where investors, beyond bringing money, can bring experience and some of the battle scars of, oh crap, I've seen this movie before, and everyone is different, but there tend to be places and points where companies tend to struggle when they're scaling.
To that point
but it's individual and it's very personal. Sorry, Josh.
Yeah, no, it is very personal. And so, but part of that scale is, to give you an example, is a lot of people we acquire, they may, hey, we got this big government job and we can't even bond it, right? Well, we acquire them, they have unlimited bonding, right? So they're like, okay, great, we're in, right? So a lot of the scale of what he's talking about of investment could just be, you want to grow, not substantially, but enough where things like being able to bond a $20 million job you couldn't do yesterday, you could do it tomorrow.
But I'll give you one more thing to consider, which was my dad, when I took the company over from him, he said, son, I'm about to give you the best gift I can ever give you. And I said, what's that, Dad? And he said, to be your own boss. And to give up that, it better be worth, that to me, you better bring a check, man, because I'm going to have a hard time working for some people. You know what I mean? So that is the other litmus test you should always ask yourself as the business owner is, do you really want to work with somebody else? Like, do you want to have a boss?
So think about this. PE firms almost always 50+%.
Yeah.
Doesn't mean you can't have 49, but they're not going to do that. Josh was talking about when he partners, they'll invest because they're interested, they're not really sure, or the EBITDA's not there yet, so they'll invest. So that's a different kind of strategy. So that does help you. But yeah, the PE firms, there are some that want to operate. So they want to own 100%. They're going to operate. That was, like to Scott's point, that was not an interest to me. I didn't want an operating partner. I wanted investors who partner with me, but I still run the company. And I will say this, my investors expected me to continue running the company, but early on, I thought they wanted me to bring choices to them, decisions to them. It took me too long to figure out that's not at all what they wanted. They were not operators.
Yeah.
They were investors. They believed in my vision, my strategy, what I wanted to do, and they wanted me to keep doing it. But it took me a few months to figure out, I'm never had a board before, right? What do I owe them? Well, what I owe them is to continue building the business that they invested in. Yeah. That's an important thing. So while you're talking to investors, really figure out what their motivation is and why they're investing in you.
So Scott and Brian hit on a really good point, right? It's just, all investors are not the same, right? They live on a continuum. Some are happy of, here's a check, send me a financial report once a quarter. If it's good, it's good. If not, you're going to get a body cavity search. Others are going to be, you're going to get our 100-page playbook, whether you like it or not. If I wanted to do that, I could have stayed at Honeywell and, gorged myself on 100-page playbooks. That's the point about with your investor, get aligned on that dimension. How do you manage your companies, right? And I would say, the ones that work the best, you hire good people, you acquire good people, let them run their business. I don't think good things happen when you stifle them. But again, that's a big dimension of alignment. How do they work with their owners, with their CEOs? If it works with your model, great. If it doesn't, it's going to be, a long, hard, ugly marriage.
All right, we have a very patient person here who's waiting for a question. Can you remember it?
I kind of pivoted while you were going through this, but I kind of piggybacked off of his question. But and then I did have a different question as well. But for something that is 100% exit or close to 100% exit, what is a reasonable speed for one to screw off and go to the beach and be done?
Well, reasonable is all relative, but depends on how sparkly your system is, meaning your accounting functions. But, we've seen people go as fast as 6 months. We've seen people go, in 2 months, but it really is the combination of, do you have leadership behind them that's kind of already managing the business, and you're already playing golf 3 days a week? We can help you go play golf 5 days a week.
This kind of is the beach a little bit.
Yeah. Well, I think that's part of your negotiation. Yeah. When you make that decision and you go down that path, that's part of some of the options you have to decide. Do I want to earn out, or do I want everything up front? It's one of the fundamental things you go through when you decide to buy.
Yeah, I think we all give a big portion of your money up front. So it's, you don't get 100% of it, but you'll definitely get a big portion of it, usually more than 50%. But, it's really contingent on you delivering what you said was there when it got purchased. So
I didn't expect to be really black and white answer, but
that's what the earnout's for, is to make sure what you said was there is going to be there in the next 3 years. That's why, like the gal that talked earlier, 3 years, you want it to be a perfect marriage. It's like, for 3 years, we got to figure that out, which is sometimes challenging, right?
There's a couple things that are in general, right? Even if, and then, one person's perspective, if we're investing somewhere, we're going to expect you to put some of your equity back into the business. Doesn't mean you have to run it day to day, but we would expect you to reinvest a portion of your proceeds back into the business. That would be thing number one. Thing number two, is, an aspect of scaling is going to be, if we're getting into a partnership, what's the plan to scale the leadership team? If you are the day-to-day operator and the company cannot function without you, we're going to have some different conversations than if you're already heavily withdrawn from the business and you've got a team underneath you. What we care about in the long run is that there's a team that's going to grow and scale and lead the business. If it's already there and the founder doesn't need to be the person, go off to the beach, Godspeed, have a great life. But, again, we just need to be clear on how the company is going to operate and be led, and no mismatches.
But I think generally there's an earnout portion of it, whether you're involved in it or not. It's kind of more your choice, right?
So the other question I'd actually had before I kind of had that off of his question was just quickly, over the last, let's say, 3 years, have you seen multiples tend to be going up or tend to be going down over the last few years?
Same.
Similar?
Up.
Up.
Up and also sensitive based on where you are, right? So, the darling of the private equity space is life safety right now. If you want to extend your HVAC business into life safety, those multiples are not so. But in general, there is more interest in private equity. So, they've been creeping up, albeit at different rates. My view.
Yeah, I think private equity and investment banking, actually, bigger firms buying, all those multiples have been going up because you've seen the consolidation more on the residential side. Now people are doing it on the commercial side, right? So it worked on the residential side, and so we see more and more commercial, conglomerates.
Thanks. I think, unfortunately, we're right at time, and I'm conscious other people have got other things to head off to. So want to just, again, we chose these themes to be navigating complexity and escalating opportunity, and hopefully you understand from this session that succession sale or scale is also quite complex to navigate. So I hope you can help me join in thanking our wonderful panel and Automated Buildings. Now, my favorite session last year at the Automated Buildings education sessions was actually the Controller Showdown 3, I think it was. So it's coming up at 4.
Coming up half hour, so don't
plug.
Come back. The manufacturers come in, they pitch their best products, and then you, the audience, you get to pick the winner. We'll put a QR code up, and you all get to pick the winner. We'll announce the winner. Don't miss it. It's a blast. Thank you all.
Thank you.